Hey everyone, welcome back. Today, we're diving into a company that's been making some serious waves in Singapore's construction scene, Pan United Corporation. And if you've been anywhere near the stock market lately, you know their name has been attached to some absolutely incredible performance. So, let's get into it.
Just look at this chart. Since the beginning of the year, the stock price has rocketed up a whopping 42.7%. That's the kind of jump that really gets your attention. It's all been fueled by record profits and this growing realization of just how vital they are to Singapore's huge construction boom.
And that is the million-dollar question, isn't it? A 40% plus jump is amazing for anyone who got in early, but if you're looking at it now, you have to ask yourself, is the party already over? Has all the excitement in the market pushed the price way ahead of the company's real value? Okay, to answer that, we really need to look under the hood at the fundamentals. And let me tell you, the story there is incredibly strong. There's a really solid case to be made that this growth is built on a foundation that is, well, rock solid. Let's start with the demand. And we're not talking about just one or two little projects here. We're talking about a massive, years-long pipeline of major infrastructure. You've got Changi's Terminal 5, the Marina Bay Sands expansion, new hospitals, more rail lines, and of course, a constant stream of public housing. And what do they all need? Pan United's main product, ready-mix concrete. This is not a short-term thing. It's a sustained wave of demand that gives them a clear view of their earnings for years. And it's not just about selling more concrete. The company is actually getting smarter about how it earns its money. First off, they're a leader in low-carbon concrete. So as Singapore's carbon tax keeps going up, their greener product just becomes more and more valuable. And second, they've built this amazing logistics software, the AIR digital platform, that they're now licensing out to other companies. That's a high-margin, tech-based income stream. So they're building two new engines for better, higher-quality profits. And this chart right here shows you the result of all that. See the red line? That's the company's actual earnings per share. You can see that steady climb. Now look at the dotted line. That's the forecast. Analysts are expecting this upward trend to just keep going. The business is strong and its profits are expected to grow. So from this point of view, all the optimism looks totally justified. Okay, that earnings forecast is compelling. I'm not going to argue that Pan United is a strong, well-run company. It clearly is. But, and this is a big but, a great company and a great stock are two completely different things. And that's where we need to pump the brakes a little and look at the price tag the market slapped on that story. Now this chart, this tells the other side of the story. The red bars, yep, that's the construction demand we just talked about. It's rising. But look at the black line. That's the stock's forward price to earnings multiple, which is a key way to measure how expensive it is. And you see that horizontal green line? That's its 5-year average. The valuation is shot way, way past its normal level. It suggests that investors are now paying a huge premium for those future earnings. Let's just break that down into simple numbers. Historically, investors have paid about 12 times the company's expected yearly earnings to own a piece of it. Right now, they're paying around 18 times. That's a 50% jump in how the stock is valued. So the real question isn't just, will profits grow? It's, are they going to grow enough to justify this much higher price? And this quote from the analyst report it hits the nail on the head. It says, the investment debate therefore shifts from validation to valuation. The first part of the story was about validation. The company proved it could deliver. But now that the price has run up so much, the whole debate has changed. It's all about the price tag. Is the stock priced fairly, or has everyone gotten a little too excited? Okay, so what we have here are two really powerful but opposing ideas. On one hand, you have a fundamentally fantastic business with a great future. And on the other, you have a stock price that has already shot up to reflect all that good news. So how does a professional analyst balance these two things? Well, the official rating they decided on is trim. Now, it's really important to note this is not a sell rating. It doesn't mean anything's wrong with the company. It's a bit more subtle. It's basically saying, hey, the company is solid, but after that huge run-up, the potential for more big gains just isn't really there right now.
In other words, it might be a good time to think about taking some of those profits off the table.
And these numbers right here show you exactly why they think that. The analysts set a target price of $1.73. With the stock currently at $1.64, that only leaves a potential upside of about 5.2%.
Right. And after you've just seen a 40+% run, a potential 5% gain, well, it feels a lot more balanced. The risk versus reward just isn't as attractive as it was a few months back.
Which really brings us back to our main question today. This whole look at Pan United is a classic lesson in the difference between a great business and a great stock. You can have an absolutely fantastic company with a super bright future.
But if the stock price has already gone to the moon to price in all that good news, it might not be a great investment anymore. At the end of the day, the price you pay is every bit as important as the quality you get.
And now for some important information regarding this analysis. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.